What did we learn yesterday from Chair Yellen that we didn't know the day before?
Well, what we learned was that the market was expecting her to shift her tone a bit, the bond market particularly, and we didn't get that. Now, what we're describing as a more dovish Yellen is not a more dovish Yellen. What she said yesterday was exactly the same things that she's been saying since March. The difference is, post the last time we were together, post the Sintra speech and the global environment that had excited bond markets to the possibility of a little bit more aggressive global central bank actions, bond yields had been on the rise, and there was some fear that there might have been a shift in tone. We didn't get the shift in tone, so it wasn't about a change in what Yellen had to say. It was about a change relative to market expectations and disappointing those expectations in the sense of delivering the same message resulted in a pretty decent bond market rally, and the equity market took off on that.
Brian, is that the same testimony that you witnessed as well?
Yeah, I think there was a little bit of noise about perhaps the Fed starting this balance sheet roll down as soon as July, and it seemed like the testimony yesterday, if she was going to do that, she would have given an indication. So that probably got pushed back to September in terms of the start of the balance sheet reduction. But I think the equity market reaction, I was a little bit puzzled by it, because the scenario in which the Fed does not raise rates in December, as they've clearly indicated they intend to do, is not a great scenario necessarily for the equity markets. It means that the Fed is either unable to generate the kind of inflation they're looking for, or they're just unable to forecast inflation, as they've been having a tough time doing for a few years. So I'm not so sure that if we're sitting in December and the Fed declines to hike, that's going to mean the equity markets have done well in the interim.
Well, exactly. The question is this good news or bad news? Because what she was saying is we're not as sure about inflation. I mean, she confirms what we all suspected, but she came out and said, you know what, we've got some real doubts about what's going on with inflation. Why is it not coming in, particularly wage pressure? And that ultimately is bad for equities. It's bad for earnings.
I would think so. You don't want to see too much wage pressure. You don't want to see overheating, but something in the middle. She's only looking for progress towards 2%. And we've been going the other way with core inflation for the better part of 6 months now. So if she doesn't see the progress that she's looking for, I think, stepping back, not raising rates. And my expectation is if they don't raise rates in December, it's not as if they're going to be looking to raise rates soon thereafter. They're going to be, they're going to take some time to pause and see what's actually going on.